if you sold a home that you were living in Canada, most people think that it's tax free and that there's no tax reporting requirement. And that is the exact line of reasoning why some people get letters from the CRA, they have unexpected tax bills, or it just becomes a huge headache for them. In this video, I'm going to explain some of the tax traps that most Canadians don't know, and I will explain it in plain English so that you don't get blindsided when you sell the home that you live in and when you want to claim a principal residence exemption. Here's the simple truth. A sale of a home can be tax free, but it's not always, and you have to report it, okay? You can't forget to not report your sale of your principal residence, okay? So a lot of people think the myth is, oh, it's tax free, I don't need to report it. That is wrong, okay? Whenever you sell a home, even a principal residence, one that applies with the principal residence exemption, you must report it on Schedule 3 of your income tax return. Okay, and if you look here on the CRA website, you actually have three different things, tabs here that are really helpful. The first one is just a general information about the principal residence. So if it says here, when you sell your home or when you have considered to have sold it, you may realize a capital gain. If the property was solely your principal residence for every year you owned it, you do not have to pay a tax on the gain. So again, in Canada, the prices of homes, they skyrocketed from like the 1970s, 80s to 2020, 2025. So a lot of people became millionaires because they didn't have to pay any tax on how much their house went up. So let's say you bought a house in the 1980s for 200K. Now it's worth 2 million. You didn't have to pay any tax when you sold it. So you get to keep all $2 million if you are eligible for the principal residence exemption. So this is a huge one actually for all Canadian taxpayers. If you didn't know, this is a very important one for us because it's probably our best exemption here because a lot of people made money on their homes when they bought it in the past. And those prices, they skyrocketed and they didn't have to pay any tax that otherwise they would, right? So if you had a $2 million capital gain like that, you'd be paying $500,000 usually in taxes on that. So if you look here, it tells you what can actually be considered a principal residence. So it can be a house, a cottage, a condo, an apartment in an apartment building. Okay, so pretty much anything that you're living in is considered a principal residence. Then they have a few things here about what actually can qualify. One of the big parts here is that you're actually living in the property, so it won't be a principal residence if you're renting it out full time. You've never lived in the property, you can't. There are specific things here where you must live in it. Again, it says here you designate your home as a principal residence when you have considered to have sold part of it. Okay, however, in some situations you may not be able to choose. So if you have more than one home, for example, and you've lived in both homes, then you could essentially decide which home you want to claim the principal residence. So you might have sold one earlier than the other and not at the same time. You can decide, do you want to use the principal residence exemption on the home that you sold or on the other one, and pay tax now on the one that you sold. Okay, so what's very important here is that there are new rules with the flipping property. So you essentially can't claim a principal residence exemption on a home in which you essentially held or owned for less than 365 days. And this would be considered not a capital gain, and this would be considered business income. Okay, it's deemed to be business income. So for example, you tried to flip a home, but you lived in it full time, not a principal residence exemption. Okay, so very, very important here. Remember, you do have to actually show that you sold. You have to report the sale and designate it on Schedule 3. So I'll show you right now what Schedule 3 looks like. So you see here, you have your capital gain. Here you have, if it's a flipped property, we say no. If it is, however, a principal residence here, you can see you'll need to complete the Form T2091 as well when doing it. Yep. by an individual other than a personal trust. Okay, so yes, so if you look at here, a deemed disposition, they tell you what it is, and you'll tick one of the boxes. You'll designate the property as my principal residence for all of the years, or for some of the years, or yeah. So essentially, I designate the property as my principal residence for some, but not all. I designate it for some of the years that I own them. Okay. So you're going to have to click the right one and then go down here into your real estate and other property and have the description as well as what you sold it and what you purchased it for. What's very interesting here is there's actually a very large income tax folio done by the CRA, which can summarize some very big issues with the principal residence exemption. So if you scroll down, they have discussions relating to when it is considered business income and not capital gain. Again, the flipping property is one in which we know is deemed business income. But if you also do this as a business, you sold many houses in like a short period of times, they can also consider that as your business income and not as capital gains. You have to make sure you have ownership required. But one of the big ones here that I want to talk about is when you have a change in use. Okay, so if, for example, you were living in the property and you ended up having to essentially rent it out, how would that be dealt with? And the answer to that is straightforward enough. You will need to, it is considered, when you have a change in use, it's considered a disposition, okay? And that disposition is not good for you because then you have to use your principal residence exemption. You still haven't sold it, so if there was any tax on that, you would have to have you'd have to pay tax on that if you weren't going to use your principal residence exemption. So if you have a complete change in use of property from principal residence to income producing, you have to do what they say. You have to claim this 45-1 and send in essentially a letter. So in theory, you have to defer the recognition of any gain to a later year under section 45-2. And what that means is you must send them a letter. So if you see here, it says this selection is made by means of a letter to the effort that the taxpayer, you're essentially saying, I know that I have changed my use from owning the home and using it as a principal residence exemption, but we're going to change it to renting it out, income producing, but I'm going to claim 45-2 so that I don't have to have that automatic capital gain disposition from change of use. If you do not claim 45-2, then you will have problems with the CRA. They can say that, oh no, that was a capital gain, and you may or may not have to pay taxes depending on whether you're going to use your principal residence exemption on that house then, or whether you and if you don't, then you'll have to pay some tax. So you must send them a letter saying 45-2, you're switching from the change in use of living in the home to renting it out full time. And then again, there are some things where they give you additional years where you can still claim a principal residence exemption even when you have this change in use. So, but it is one of those things that you actually need to do twice, for example. So if, for example, you went from renting to living in it, then you have to do a 45-3 election, which is the same thing as sending in a letter. Okay, now, a lot of people don't know that you actually have some important documentation that you need to send the CRA when you are renting out your home, or when you're going from renting out your home to living in it. Okay, and that's one of those things that oftentimes get missed. Okay. So if you own two homes, also, this is one of those traps where you can get caught with not knowing how to deal with that. So if you own two homes at the same time, let's say it's a cottage and a home, like a home that you live in. So if you have that, you can only claim a principal residence exemption on one of those homes each year. Okay, so you can't claim it on both. You can only claim it on one. And the best way to do that is to figure out which one will have a higher capital gain. okay, over the years. So which one went up more in value? If you want to figure out what is the capital gain per year on those homes and take the highest one. Okay, so that can be also tricky because people sometimes just claim the principal residence exemption on the cottage if they sell it first, even though that would not be the best when they sell the home. That wouldn't be the best tax outcome. Okay, so that's something you need to consider. Also, what's one that also, yeah. So I guess if I was to summarize kind of the traps here you would have with the principal residence exemption, it's making sure that you don't fall under that flipping risk. So you got to keep it for more than 365 days at a time, so that you're not deemed a business. You want to make sure that you send in your 45-2, 45-3 election when you're changing from fully renting to living in, and from living in to fully renting your home, because it is considered, when there's a change in use, an automatic disposition of the home, which means that there will be tax consequences unless you send in that election. Okay, so that's number 2. The third thing is, if you have more than one property, let's say you have 2 properties, make sure that you decide to take the principal residence exemption on the one that has a higher capital gain per year. Okay, so the one that, let's say, one went from 100,000 to $1 million, and the other one went from 200,000 to 400,000, and over the same amount of years, I don't know, 5 years, it'll be better to take the one that went from 100,000 to $1 million. Okay, so you want to take that into consideration. And finally, the tax requirements on your behalf that is necessary for you to do is making sure that you fill out Schedule 3. In Schedule 3, you'll see the part that relates to the principal residence exemption. You'll have to also input the amount that you sold it for, the details of the home, so the address and the amount you bought it for. And as well, you'll need to complete an additional form along with that, which will be the T2091 individual, if you're an individual that sold the home. Okay, so not a trust or anything else. So that's essentially it. If you are looking to file your tax return, I suggest using Wealthsimple Tax. Wealthsimple Tax is the software that I use. You'll be able to claim your principal residence exemption using that software. And take a look at the link in the description. If you end up funding your account, we will both get $25, which is great. So yeah, if you are planning on doing your tax return and you have a principal residence exemption, check out Wealthsimple.